In this video, I'll go through my entire portfolio and reveal its performance so far this year and since I started way back in 2009. I'll also reveal what I've been buying and selling and my plans for the months ahead. Over the last 14 years, I've been investing mainly in large cap UK companies which I hold for the long term. In recent years, I've added several exchange traded funds to increase diversification and reduce risk. I make good use of a stocks and shares ISA using the Barclays Smart Investor platform, so I don't have to pay dividend or capital gains tax. I'll go through each sector in ascending order of performance for the year so far. This is not investment advice, I'm simply showing you my own journey. In the mining sector, I only have one company, Rio Tinto, and it's having a poor year so far. Weaker demand for iron ore from China is having a negative impact on demand. As I go through the slides, this figure shows the average price change in 2023 for the companies I have in a given sector. It's only based on the companies I hold and not the industry as a whole. This figure shows the value of my current holding, and this figure shows how the price has changed this year so far. And because Rio is the only company I hold in the mining sector, it will be the same as the figure at the top. And finally, here is the dividend yield. I have £8,200 invested in Rio Tinto, so I would currently expect to receive dividends of around £640 a year. Down 12.4% is Scottish Mortgage Investment Trust, which I've only recently bought. You can see here it's comprised of global growth and tech stocks, many of which have had a pretty poor run over the last 12 months or so. Only time will tell if I've made a good choice here. Recent government changes to dividend tax mean I have to start looking for shares like this which pay a low dividend and which I can keep outside the ISA and remain below the tax allowance. There isn't enough room to keep everything inside. In the insurance sector, I have only one company, Aviva, and it's down 5.9%. Aviva pays a decent dividend and the company has slimmed down its operation to focus on core markets. In the long run, that can make a business more profitable as it applies its resources where it has a strong chance to succeed. In the food and tobacco sector, I have three companies. Both British American Tobacco and Imperial Brands pay large dividends and often do well in difficult times, but they are both down this year. Tate and Lyle, on the other hand, is up nearly 14%. It's a simple, well-run business despite the lower dividend, and I'm happy to hold for the long term. Next is an exchange-traded fund from Vanguard. This one has the ticker code VHYL. It gives you exposure to over 1,800 global companies which pay higher dividends. I've only recently been investing in this ETF, but it really ticks all the boxes, as it pays decent dividends and gives great diversification. Here are some of the largest companies you would have exposure to. I plan to buy a lot more of this ETF in the months ahead. In the banking sector, I own 4 companies, and the average share price is more or less unchanged. Banks should be more profitable with higher interest rates. However, it's a bit of a double-edged sword, because if rates rise too much, there is an increased chance of borrowers defaulting on their loans. Of the two here, HSBC has performed much beher this year. I also have Lloyds and IG Group. Performance is patchy, but as with all banks, the dividends look decent at least. In the renewable energy sector, I have 3 companies in total. Bluefield specialise in solar energy and Greencoat in wind energy. Both pay good dividends. The third is the Renewables Infrastructure Group, which owns assets in both solar and wind energy. The share price of these 3 doesn't really change that much, but they should hopefully churn out reliable dividends for the foreseeable future. In the pharmaceutical sector, I have 2 companies which I've held for over a decade, and the share price of both is relatively unchanged this year. AstraZeneca is the largest listed UK company by capitalisation. It's so big that it accounts for 9% of the entire FTSE 100, and its shares have been surging in recent years. In terms of total return, it's been my best company since I started. GSK is a very different company today than before last July's demerger. It is now a more focused and streamlined business. Up 3.9% this year is an S&P 500 ETF. This ETF has the ticker code IUSA and gives you exposure to all those large American giants in one simple share. With its low yield of 1.4%, this is another share which I like to keep outside the ISA for now, And yes, I plan to buy plenty more of this ETF in the months ahead. In the chemical sector, I own just one company, Croda, and I've been buying a lot more of this over the last year as I sense a long-term bargain. The company has enjoyed market-beating returns for years, yet it's currently down significantly from its all-time highs. I think now could be a potentially attractive entry point for this long-term stock. The yield is fairly low at 1.6%, which means I can keep it outside the ISA and not worry about going above the tax-free allowance. Up 4.6% is a FTSE 100 ETF. This one has the ticker code ISF. The yield is currently 3.6% and you get exposure to the whole UK large cap index in just one share. Here are the largest holdings you would own. This was the first ETF I ever bought, and I occasionally buy more when I can't see bargains elsewhere. In the consumer goods sector, I have three companies. Diageo and Unilever have strong brand loyalty and large economic moats. Last year I invested more into Unilever than any other individual company, as I sensed a short-term weakness in the share price. I think both these global giants will do well over the long term. Haleon is relatively new. It was spun off from GSK and recently paid its very first dividend. Here are some of the well-known brands which it owns, and these three have literally been flying off the shelves due to the high number of cold and flu cases. I also wouldn't be surprised if Haleon becomes a takeover target in the years to come. About a year ago, Unilever made an unsuccessful bid for Haleon. I'll definitely be holding this one and may even add more in the year ahead. Up 7% is the oil and gas sector, and I have two companies. BP has recently posted better than expected Q1 profits of $5 billion. BP not only pays a decent dividend, but it is planning more share buybacks. By shrinking the number of shares in circulation, it should boost the value of existing holdings. Likewise, Shell has recently posted a big jump in profits and also plans some big buybacks to boost the share price. Be cautious, however, as some sectors like oil, mining and banks are cyclical sectors, and there will be periods when they underperform significantly. I've actually been reducing my holdings somewhat in Shell and BP in order to rebalance the portfolio. In the utility sector, I have three companies. These two have risen well this year and offer decent dividend yields. National Grid has continued its strive for cleaner energy, and SSE continues its plan to build new wind farms. I've been buying more shares in both these companies recently, hoping to benefit from their recent momentum. United Utilities is up 7.2%. There are risks, however, especially with threats in the form of regulatory fines over sewage leaks and dirty rivers. My second best performer this year is the retail sector, and I have only one company, Tesco, and the shares are soaring, up nearly 22% this year. Despite a constant threat from the discounters, Tesco enjoys a 27% market share, and I'm happy to hold for the long term. I'm even considering adding to my holding. My highest performer so far this year is Defence and Aerospace, up 35%. The BAE Systems share price has roughly doubled over the last 2 years and has recently crossed the £10 mark. Given the high levels of geopolitical tensions, governments are spending heavily on defences. At the end of 2022, the company had an order backlog of nearly $60 billion. RollsRoyce has had an even more impressive run with a share price increase of 53% since the start of the year. It's quite simply one of the best performing FTSE 100 stocks of late. Many still believe the shares to be undervalued. Air travel is rising and a substantial amount of revenue comes from servicing aircraft engines. Despite a 35% increase this year in air travel, we are still only 65% of 2019 levels, so perhaps there is even more upside for this company. Net debt is also falling significantly. Now, just before I reveal all my buys and sells this year, I'd really appreciate a quick tap of that like button, as it really helps out the channel. Thanks. With the portfolio now paying out well over £1,000 a month in dividends, I don't always have to put new money in to buy more shares. Here are all the purchases I've made over the last 4 months. I put more into RollsRoyce this year than any other share. Second has been Croda, and third has been the All-World High Dividend ETF, ticker code VHYL. I've continued to reduce my holdings slightly in oil and gas by selling a few shares in Shell. but it still remains my second largest holding. Cash in the portfolio currently stands at just over £11,000. Now for the portfolio performance this year. At the end of 2022, the portfolio stood at £359,000, and after the first 4 months of this year, it surpassed £400,000 for the very first time. £15,000 of new money has gone in, giving me a net gain of over £26,000 in the first 4 months of this year. The percentage gain is 7.4%. I'm now going to compare the performance of the portfolio with other indices. To do this fairly, I'll strip out any dividends I've received so far this year. This still leaves me with a capital gain of 6% for the first 4 months of the year. You can see in this table how the performance compares to other indices. It's been a good start to the year so far, but look how well the S&P 500 has done. I've become a real fan of this index recently, and last year I put more money into my S&P 500 ETF than any other share. The ticker code is IUSA, and it gives you exposure to the whole index. Here are some of the largest companies you would own. I'm definitely planning on buying plenty more of this ETF in the months ahead. Now for my overall performance since I started in 2009. I made plenty of mistakes in the early days as I was learning, and these results include everything. The total amount I put into the platform is $240k, but remember I didn't put this in all at the start in one big lump sum. I simply drip fed in spare money each month. If I had been able to put all this money in right at the start, then my gains would have been much greater, and I would most probably have done better if I had invested into an index tracking ETF right from the start. But they were not mainstream back then, and I was limited to buying individual UK stocks on my Barclays platform. The value of the portfolio today is 400k, giving me a gain of 160k or 67% if I was to sell all my shares today and walk away. It's not the capital growth which really motivates me, however. It's watching those monthly dividends grow from year to year which inspires me to continue. Generating streams of passive income gives you options in life to choose how you use your time. But how did this journey begin? Well, it all started one day with a simple cup of tea. Why not put the kettle on and I'll see you over there?